Hey folks, Ray Barton, Coldwell Banker Flanagan Realty. I'm a realtor associate here, also known as RayTheRealEstateGuy.com. Today I thought I'd bring to you something that was a little bit special. I had an opportunity to interview one of our local loan officers from a company called Advisors Mortgage. Len Herbert offered me some time, and I thought maybe I would take it and ask him some questions having to do with mortgages and interest rates and so on and so forth. So I hope you find this segment very interesting. It certainly should be for those who are particularly first-time buyers or those who are looking to remortgage. So without me spending a lot of time talking, let me turn it over to Len Herbert, and you can listen to our interview. Great. Now, this segment might be called questions that a prospective purchaser should ask your mortgage broker or lender. Stay tuned for some valuable information. And as I've stated in the past, I work with a number of reputable lenders in the local area, and you might, as a client, want to have some choice. But common to all who are seeking a mortgage, there are always questions they ask and answers that you need to obtain to secure a loan that meets your needs. Today, we're lucky enough to have one of those lenders, Mr. Len Herbert, who is the branch manager and loan officer for Advisors Mortgage in Waretown, New Jersey. And I'm hoping that Len can provide some typical answers to questions that you, the borrower, might want to ask. Len, so welcome. We appreciate your time and willingness to be interviewed. And as always, we look forward to getting educated on things that you do.
Well, thank you so much, Ray. I appreciate it very much, and I'm humbled by this, like I had mentioned, and appreciate it, and just looking forward to sharing what I know to maybe help somebody else.
We appreciate your time. I know you're busy and you don't get much time to yourself, so I really appreciate the opportunity to interview you.
My pleasure. Thank you.
So if you don't mind, let's dig into some questions that I normally would encourage a potential borrower to ask a mortgage broker or lender. There are probably around 10 questions that I think are important, but Len, I would ask you to kind of guide us along and maybe, I'll kick it off by asking a couple of them, and then you can kind of chime in and tell me what's more important. Okay. The whole idea of this is to educate our client base and make sure that they're getting what they need when they consider a loan for their dream home purchase.
Okay.
Okay. So the first question that I encourage people to ask is, which type of loan is best for me?
Well, I'll tell you, that's a good question, and I get that question a lot from potential buyers, borrowers that I actually speak with, and my answer really is always the same, in that it's the best loan for me may not be the best loan for you. There are circumstances surrounding everybody's lives that are important to uncover to determine what's the best loan for them.
Well, I know that there's things like adjustable rate loans and interest only loans and negative amortization loans and FHA and VA and those types of things. Maybe just take a second and explain some of the different types of products that you represent.
Those loans are out there. However, the majority of loans, the overwhelming majority, I would almost even venture to say all of them lately have been fixed rate mortgages, because the interest rates, as you may know, or as you're listening, you may not know, have been really, really low. And traditionally, adjustable rate mortgages, for comparison, have been around because at some point in the past, they offered a lower rate than a fixed rate mortgage. And that's not really the case today. So there's really not a reason for anybody that I can think of to go with an adjustable rate mortgage. Fixed rate mortgages are really the way to go as of today, as of 2021, in January 2021. Aside from the term fixed or adjustable, You did mention different types of loans: FHA, VA, USDA, and conventional. And those loans vary slightly with guidelines, and that stuff is important to talk about too, because you might have a little bit of money to put down, or your credit scores might be a little bit less than what you would like them to be. And those things, those types of facts about you or the buyer, borrower, really, really are important in going into rather determining what loan is best for them, what loan is best for you.
Thank you. That explains some of what I've heard, and it's helpful to know. You mentioned something about interest rates, and we all see on the contracts these things called interest rates and annual percentage rates, APRs. Could you explain what that is?
I can. So an annual percentage rate is APR stands for annual percentage rate, and what it is it is a calculation that was meant for the customer to be able to compare loans equally, and it's based on there's the calculation that takes into consideration your closing costs and kind of like backs them out to see what your monthly payment would be, right? However, the APR can also be manipulated because there's things in there like interest, for example. One lender might be calculating an APR with the interest beginning in the beginning of a month, and another one might be calculating it with the interest beginning at the end of the month. So the APR calculation is just what it is. It's a way for consumers to compare their loans side by side, but it's not always the best way, in my opinion, to compare because it could be manipulated a little bit.
So you would help guide a borrower through that myriad of APR discussion, I guess, if they asked, right?
100%, absolutely right.
One of the things that everyone worries about, particularly nowadays, and we see this a lot with first-time home buyers and new people, is this idea: how much down payment is required? And I know that there's some important information around loan to value ratios. Maybe you could explain, what's typically needed for a buyer today.
Well, that is a fantastic question, and actually a topic I love talking about because, believe it or not, one of my friends, I've been friends with this gentleman for, 35 years. And he bought a house in the beginning of this year, and he was always under the impression that you had to put 20% down to buy a house. And with me being friends with him for so long, I felt like I was doing him a disservice. I'm like, how can somebody that I know so well think that? And the fact is, you can actually buy a house with as little as 0% down. So really, there's a big, big disparity, I guess you can call it, in regards to how much you could put down. You could put as little as 0% down using a USDA loan or a VA loan. FHA loans allow somebody to put as little as 3.5% down, and even some conventional loans, depending upon where you're buying and what your income levels are, you could do as little as 3% down. So there's a wide range of down payments that can be made. But don't make the mistake and think that you need to put 20% down to buy a house, because you don't.
So it's really up to the complete profile of the buyer. And again, my guess, and having worked with you, I know that you ask a lot of questions to help get the best product for the consumer and give them guidance on what might be best to help them get into their next house. So that's good to know. I mean, I think everyone worries about needing a lot of cash, and that may not be as high as they thought it was. So
it absolutely 100% may not be the case. That's why I always suggest, even if you're, and I'm probably sure you suggest the same thing, even if you're kind of like just thinking about buying a house, it's well worth time spent to talk to a lender to help that lender should help you understand what options are available to you, versus just kind of thinking what options are available to me.
Yeah, the last thing you want to do is take someone out to see a home and find out that they're unqualified. So you do help pre-qualify people, give them some guidance as to what they should be looking for, what you think that they can get qualified for.
100%, absolutely,
That's good.
absolutely.
That's good.
And I think that's really, really a very important step, whether, somebody, whoever, whether they call me or whoever, but that really should be, in my opinion, one of the first things that you do when you're thinking about buying a house.
Yeah, I agree. It makes things much simpler, and the consumer has the idea that they can now go out and look at something in their price range, something that they can afford, and not get wrapped up looking at other things and make, informed decisions. So I think that's a great service, and I appreciate that.
Yeah. I think reputable lenders are in their communities to help their community with those types of answers. And so that's how I view myself, and I'm hoping other lenders view themselves the same way.
Yeah, no, I appreciate that a lot. I know that you do that, and that's one of the reasons I asked to get you on today and talk a little bit about that.
Well, thank you.
What are this thing called discount points and origination fees? I mean, when we place a mortgage, and we just talked about briefly with the APR, there's always a whole number of things that go into an APR, early payoff, interest, fees, and that type of thing. But oftentimes we'll see advertised, discount points or origination fees. What is that, Len?
So a discount point, Ray, is basically a dollar amount. 1 point is always equivalent to 1% of what somebody's loan amount is. So if somebody's financing $200,000, 1 point is equal to $2,000. And so what points can do is it can buy down somebody's interest rate. So if somebody is getting quoted an interest rate of 2.5%, that person might decide to pay a point to get a lower rate. Now, what's important to know about points is that oftentimes they can be used in other ways. And what I mean by that is, instead of paying a bank a point to get your interest rate lower, it could certainly prove to be a better expense to pay yourself that point and use that money as an additional down payment. So I mean, points really should never be on just a standard fee. I mean, it's something that you should elect to pay after understanding what it is. But if you are getting charged points, you shouldn't be. I mean, in most cases, there are certain scenarios where you might have to pay a point. And I mean, like, really involved, like a 2-unit investment property with 20% down and not the greatest credit, really certain circumstances. But for those people out there, most folks who are just buying a primary residence to live in and raise their families in, points is something that generally you shouldn't see on your closing cost worksheet or your loan estimate.
What about origination fees? Sometimes I see charges in order to even process a loan. How does that work?
Well, origination fees, years ago, different lenders called their fees different things. So, one lender might be calling their fee a commitment fee, and another lender might be calling it an application fee, and another lender might be calling it an underwriting fee. So I guess maybe around 2009, somewhere around there, Dodd-Frank came in and they said, hey, listen, lenders have to charge so consumers can compare accurately. Lenders should call their specific fee the same thing. And so the name at the time was called an origination fee. But before that rule came into play, an origination fee was kind of like the same thing as a point. So if you see an origination fee these days, it's usually the fee that the specific lender charges to originate, process, underwrite, and close your loan.
Okay. So there are costs. And when you're talking to a client, obviously you're saying to them, you can buy this house, or you'll have enough money to buy a home between X dollars and X dollars. And then they get to the table and they find out that they need more. Do you tell them about any of these costs that they might have above what the loan is?
I do. I'm 100%. As a matter of fact, it's a lender's kind of like role in the home buying process to help consumers understand what those costs are. So, as you can imagine, when you go to buy a home, there are services that need to be done on your behalf in order for you to close on that home. I don't mean you specifically, right? I mean somebody who's buying a house. So for example, we just talked about an origination fee. That's typically a lender's cost, right? But also, you have to do an appraisal. An appraisal uh, verifies the value of the home that's being purchased. Credit reports need to be run. Title insurance needs to be obtained. The mortgage and the deed need to be recorded in the courthouse wherever you're purchasing. Most times, an attorney will be involved. So those group of costs are called closing costs. And the way I like to describe closing costs to my clients is a group of fees for services rendered, meaning that people are going to be providing services for you on your behalf in order for you to close on a house. The things that I just mentioned, appraisals, recording, title insurance, that kind of thing. Depending upon the purchase price, those can vary a little bit because title insurance premiums are predicated on the purchase price. So those are closing costs. And then you have this other group of monies that need to be brought to closing, but aren't necessarily fees. They're really your money, and they're called prepaid items. And prepaid items are taxes, tax escrows, homeowners insurance escrows, and interest. So that group of items are called prepaids. And in case you don't know, taxes in New Jersey are paid 4 times a year. They're paid in February, May, August, and November. So depending upon when you close, typically there's a portion of the quarter that you're closing in due for taxes. And then what happens is it's necessary for a lender to develop an escrow account to pay the taxes that are due the following quarter. And so the aside from the down payment, like I said, you have these closing costs and the prepaids that also need to be paid at closing. Or so you also have to consider that money is going to be part of your total funds needed to close. And it's an important part of the process because if you don't have those, you can't close. So it's always part of my conversations, actually.
So how do they remember all that?
What I like to do is I like to provide my clients with something called a closing cost worksheet. So what I'll do is I will, let's say somebody calls me and they're looking for a house of $300,000 price range. I will typically prepare a closing cost worksheet for them, and then email it to them so they have it there, so they understand what they're looking at between the down payment and those fees.
Yeah, it must be very helpful for them.
Well, the feedback I've gotten is that it is pretty helpful. So far I think it is.
No surprises and complete transparency. It always works.
No surprises, and you are right. I agree with that. I agree with that phrase.
Rates, we see rates all over. I mean, just a year or so ago, I saw rates as high as 4.5% or 5%, and now I'm seeing them 2.25%, 2.5%, 3%. I mean, how often do they fluctuate, Lenny?
They can actually fluctuate daily. The biggest driver of mortgage rates, is something called mortgage-backed securities, and mortgage-backed securities are traded every day except the weekends and holidays. And so those mortgage-backed securities are traded just like stocks are traded. And depending upon how that price of that mortgage-backed security is going really determines interest rates. That's the biggest impact on interest rates. But to point out what you were saying, rates about a year ago were about maybe 1% higher than they are today. So a lot of the rates for a lot of the programs out there, a lot of the loan types out there are just hovering just below 3% for 30-year fixed loans. The shorter the term, the lower the interest rate, however, the higher the payment, because the amount of money is being paid back over a shorter period of time.
Sure. Is there a way to guarantee that rate? Since it changes all the time, is there a way to lock in, if you will?
There's a way to lock in an interest rate However, you have to have a property first. So you have to find a property first and be under contract first. And we're talking about purchases. If somebody's refinancing, it's different because they already own the house.
Right.
But essentially, if you go under contract to buy the house, the conversation that I have with the customer, the client at the time is, hey, this is today's rate. You can lock this rate in today. And if you do that, you protect yourself. So let's say we're talking about a 3% rate. If you lock that 3% rate in today and the rates go to 5% tomorrow, which wouldn't happen, but just to show an example, you're protected that 3%.
Okay.
However, also the opposite is true. If you lock in this 3% today and then tomorrow they go to 2.5, it's really, really, really difficult to be able to get you that lower rate. So it's important that the client understands this and that they're comfortable with what their payment's going to be.
Okay. I often talk to people and they're telling me that they have this thing called a prepayment penalty. How does that work? If I get my loan off early, can't I just walk away?
Well, good question. So as far as I know, prepayment penalties, are literally a thing of the past. Going back to that Dodd-Frank Act from about maybe 10 or 12 years ago now, they're no longer exist. You cannot have a prepayment penalty on a mortgage. So if you close on your house today and 4 months from now you come into a large sum of money and it allows you to pay off your mortgage, you can do that without being penalized.
Yeah, thanks. Thanks for the clarification on it, because people still talk about it as if it's still going on, and I have not seen that in a long time. So thanks again for the clarification.
No, you're welcome.
I know there's different types of mortgage companies or mortgage providers. Are lenders all equipped to approve loans in-house, or do they have to go elsewhere?
Not. I don't think all lenders are equipped to approve loans in-house. And the thing that comes to mind when you ask me that question is that, so for example, I work for a company called Advisors Mortgage Group. So when somebody comes to me, I go through the pre-approval process with them, pre-qualification process with them. If they want to go a step further, I'll originate their loan. I will ask them for documentation, or their loan will be processed and underwritten and closed, funded by Advisors Mortgage Group. There's also something called a broker. And a broker is a little bit different because a broker might do the same thing as far as pre-qualifying and pre-approving. However, when it comes to time to process that loan and close that loan, they might be going elsewhere other than their specific company. So that's the difference between a broker and a banker. We're Advisors Mortgage Group is considered a mortgage banker.
What about things like FHA and VA loans? Are they? Is a company like yours approved to do that work, or do they have to be approved through the government agency?
Well, yes, a company like Advisors does need to be approved through, I think it's called Full Eagle for FHA. I'm not sure if it's considered the same thing for VA, but we do have those qualifications, approvals. We underwrite FHA loans, we close FHA loans, and same thing with VA. We have actually we have a few really awesome underwriters for both of those types of loans.
Thank you. I know that sometimes will delay things. And in talking about delays, one of the questions that always comes up is, if I come in on Monday, can I buy the house on Friday? And, I often tell people, even if you have cash, that's difficult. How long does it take to fund and process an average loan from the point of your first visit to the point of a close?
I would say on average, Ray, I would say probably somewhere between 30 and 45 days on average. Sometimes maybe a little bit quicker than that, depending upon, there's a process to buying a home. And so you're going to go through an attorney review period. You're going to have your home inspections done. Typically, we don't want to order an appraisal until after the home inspection is done. If during the home inspection, some things come up that need to be negotiated. That may cause a little bit of a delay in ordering that appraisal, which is important in order to get to the closing table. And then different people have different loans. Some people are W-2 income and great credit, and easily be able to verify their assets. And then others are self-employed and getting gifts. And so the difficulty level of loans is not all the same. And so that's why I say on average between 30 and 45 days.
Yeah, I think you're correct. I think the national average is around 43 days. And in my own practice, I often tell people, even though it says on the contract you're going to close on a date, that date really is a target date because you have to rely on the lender to be able to process everything. And he gets delayed one day, that closing date may also get delayed. So that's good to know. 35 to 40 days is kind of 45 days is kind of
30 to 45 days. 30 to 45 days. And again, it is, you're right, that a lot of it is driven by the lender, but there are also, different things happening.
Sometimes we will see where the lender says, okay, we're ready to go. And things happen immediately. Other times they're not quite ready to go and everyone's in a pressure cooker to get the property closed. And everyone's anxious and everyone needs to, we got to get out of the house on the day of the closing. I need to schedule my movers and I need to do whatever I need to do. And, I always tell my people, please work very closely with your lender. Make sure that the lender is on board and will continue to work towards his date. And then your stress level will go way down. So, that's very good.
Yeah, I agree with you. It's important to share those types of facts with, your lender that you're working with, because, it's important to me, I know, and my team, and I would imagine it's important to whoever it is people are working with to meet your needs. I mean, these dates are important and, I think everybody probably does their best in order to try to accommodate other.
I know you guys.
Yeah.
I know my experience with you has always been that you're working very hard in order to accommodate the dates that everyone requires, and I know our customers have appreciated that. So thank you.
Well, thank you. I appreciate
Len,
it.
are there any questions or items that we maybe should have been talking about today? Maybe there are other things that you'd want to throw in, or.
Ray, that's a good question. The only thing that comes to mind at this point is to really, work with, I feel again, I'm here to help my community. I'm here to help my clients. I'm here to help my community. And to me, that means getting to know them, and really providing them with a service that's best going to suit them. Within loans itself, depending upon what the interest rate is and the term is, loans are amortized differently. And so what that means is that when a loan closes and you start making your payments, a certain portion of your payment every month goes towards principal, a certain portion of your loan every month goes towards interest. And as the months go by, less goes towards interest and more goes towards principal.
Right.
So I think it's important to really understand your client's scenarios, because the amortization of those loans is important. Maybe you have children that are 5 or 6 years old, and you're going to want to send them to college one day. And because shorter term loans allow you to gain equity faster, maybe that's important to you, because maybe gaining equity faster is going to help you send them to school in 15 years. So to understand all those types of things, I think is important. So just work with somebody who cares about you.
So talking about that, how do clients get in touch with you?
Best way to get in touch with me, Ray, really is my cell phone. And my cell phone number is 732-684-5771. Email is always a good way to get in touch with me as well. My email address is Herbert, Herbert, @advisorsmortgage.com. I'm on Facebook. People can find me there. You always know where to get me, but those are the main ways that people can get a hold of me.
Len, I can't tell you how much I appreciate your time and valuable advice that you've given us today. There's a lot more to it than just going in and applying for a loan, isn't there?
I believe that I absolutely believe there is. It's a plan. Yeah, it's a plan. It's just not applying for a loan. It's a plan for your life. So you just want to make sure that you plan properly.
So if you'd like to talk with Lenny personally, feel free to contact him direct or contact me for his information. I'll be glad to provide you with a copy of the questions that you can review with him. I'm sure that he would be glad to do that. And frankly, I know Len to be very thorough and very helpful. So again, Len, I appreciate your time. We thank you so much for the effort that you put in here this morning, and hopefully some of our viewers will get some benefit out of what we talked about.
Well, I hope so. And if there's any questions anybody has for me, like I said, I'm always happy to help. But thank you so much, Ray. I appreciate it.
Thank
And
you. Have a great day.
you too, Ray. Thank you so much.
Well, I hope you found that this information was very helpful. It certainly, there was quite a bit to digest there. So if you have any questions, give me a call at 908-309-2222. Ray Barton, Ray the Real Estate Guy. I'm here, ready to help you. And, I deal with many loan officers, and I'd be more than glad to get you in touch with the right person. So have a great day. Enjoy the week. And I hope that, again, this information was of good value.